A very good morning to all the friends from the media. Thank you for taking the time out and being here for our webinar. Today we have with us Mr. Neerav Sheth, who is our CEO of Institutional Equities, and Mr. Seshadri Sen, who is the head of research and strategist for Emkay. So without further ado, you all know the agenda of today's webinar. I would request Neerav to start the session.
Thank you, Nidhi, and guys, welcome you to this webinar. Appreciate your taking time out. I'll just have a very quick introduction, and I would let Sen, who heads our research and strategy, to give his view on the market. Broadly, our sense is that we are mostly done with the sharp correction. This is nothing unusual. So I think this is not that we are seeing this movie for the first time. You had a very, very extended bull market post-pandemic, and some of the stocks have gone up by 10 times. The small cap index was up nearly 5 or 6 times. So I would call this fairly healthy in terms of a 30% pullback in correction. Markets tend to overextend both on the upside and the downside. So again, this is very much a part of the playbook. We believe that a part of this, obviously there are triggers to the correction, and therefore a part of that to us is obviously we've seen earnings, earnings moderated. In some cases, there was a reasonable pullback for some of the sectors. Which I believe was largely a function of two big macro plays. Obviously, we've gone through big fiscal consolidation that got accentuated by the fact that there was election-led delay in spending. We've seen a lot of the investment stocks getting clobbered because of that, because markets will try and extrapolate these too far out in the future, and we disagree. And also the fact that I think we had an unusually tight monetary policy. The good thing is that both the things have reversed. So I don't know, whether you guys have followed it or not, but if you now look at the long-term targets, the anchor for fiscal now is debt to GDP, which is pegged at about 50% by FY 30-31, which broadly, if you work backwards, will largely put the fiscal deficit in and around 4.2 to 4.3%. So you don't have any negative impulse going forward. And obviously, you've seen rate cuts and a far more proactive liquidity, situation as far as the RBI is concerned. This all puts us for a second half recovery. So just to summarize, I think that at least from the 30 years that I've spent in the market, if I look at the macros, the Indian macros, I think very, very robust. Big credibility of RBI, inflation largely under control, current account deficit superbly under control, despite the fact that you've seen some pullback in currency. Over the last 2 or 3 years, we have behaved better than current account surplus economies, right? So this is very, very strong building blocks on which I think the corporate India has to build. We feel bullish, and you just can't pinpoint the exact day when the markets will bottom. I would figure that we are very, very close to it, if not already over there. Which means that you should have reasonable double-digit returns in the market over the medium term. Both me and Sen will take questions later on, but I pass on this to Sen. Sen, over to you. You're mute, Sen.
Thank you, Neerav, and thank you to all our friends in the media for taking time out to attend. We appreciate the time you've taken, and it's always a pleasure to interact with the media and share our views. This is a summary of what we have in our formal view. We think that we are, as Neerav discussed, this sell-off has largely been triggered by earnings downgrades, and we went into October at a slightly frothy valuation as well. Both those factors are now playing out, and going forward, we think we are closer to the end than the beginning of this sell down. Amit, we can move on. The big call that we are making is that we are expecting a recovery in discretionary consumption in the second half of this calendar year. That it is driven by two major factors. One, we see green shoots in hiring. The Naukri job hiring, and we are talking about formal employment, not the informal sector. In the formal sector data is hard to find on a concurrent basis, but the Naukri Jobs Peak Index does give us some insight into it, and that number is starting to improve, as you can see in Exhibit 1. More importantly, the two sectors that are pivotal to overall formal sector hiring in India, IT and BFSI are both showing green shoots, IT more than BFSI. We are not in the camp which believes that AI will be a long-term disruption to IT hiring. We've seen this argument made before, and more or less every time it turns out to be wrong. So the other factor is a revival in loan growth. We think that the RBI, as Nirav had mentioned, has over-tightened, and we are seeing signs that loan growth should start to recover. Exhibit 3 shows the sharp decline in unsecured lending, and we think that has contributed to the consumption slowdown. And once we get closer to the end of the, if we get further into FY26, this will start to reverse, and banks will start to lend a little more aggressively in the unsecured space. The asset quality worries there are also somewhat abating. And next slide. On the mass consumption story, we are also constructive. That's one area which has seen a 4-year winter post-COVID. It has never really meaningfully recovered. At this point in time, the post-COVID stress has, I think, played through the balance sheets of those households. And there are two positive factors. Of course, the women-centric welfare schemes that multiple states have involved puts money in the hands of many poor families. That will play out in multiple ways, but at the end should also benefit consumption. We are also seeing a strong winter crop. One factor is that overall, and not to do so much with mass consumption, is that through this cycle, real estate has stayed strong. And that is very important for the economy as a whole. And if you're seeing why we think this is a cyclical and not a structural slowdown in the economy, we look to the real estate sector and you see the positives that come through there. The other big call that we are saying, on the one hand, we are very constructive on discretionary consumption, and we think that will start to revive. On the capex cycle, we think that there will be a moderation. Between 21 and 24, capex growth by the central government was 31% CAGR. That will moderate to somewhere in line with GDP at 10 to 13%. In context, it is not a bad thing. If the center can sustain a 10 to 13% growth in capex over a 5-year period, that I think will lead to massive productivity improvement for the economy. But in the context of where we are, there will be a moderation. We have to look at valuations in that sector. FY25, as Nirav was referring to, was a bit of a sharper dip because of the elections and the inability to resurrect some of these projects post-elections. We think some of those will start to come back in FY26. But overall, CAGR from here will be lower. But however, we are fairly confident that it will be more consistent than it was, say, in the pre-COVID period. We are not so constructive on seeing a recovery in corporate capex. The data point that a lot of people miss is that the asset-heavy sectors, and Exhibit 9 tells you that asset-heavy sectors like energy, materials, and utilities are not investing that heavily for multiple reasons. Energy, say refineries, the case for building a new refinery is not there. There is, yes, some investment happening in green energy, but it is not enough to take up the slack that is being seen because we are not investing in refinery capacity. Similarly, steel sectors like steel, aluminum, etc., seeing some green shoots, but they're not investing in the scale that it used to, say, between 2005 and 2015. Some of that is not a bad thing. The capex side, the NPL cycle in the banks between 2015 and 20 is because many of these sectors overinvested using debt. So it's not a bad thing, but we think that capex in summary will largely be led by the central government. Next slide. We also think that financial market stresses will start to ease. The rupee is, this is the worst we're seeing of the rupee. The dollar, the DXY, the US dollar index has peaked as it did in 2017 with Trump's inauguration. After that, we will find over time that many of Trump's threats are weaker than what they finally turn out to be. And to that extent, we think that the case for, because there will be tariffs, that the US dollar is on a structural upswing, that will not figure out. We are already seeing that. I think the US dollar is already peaked and is not giving that much stress from here on. On the other hand, the RBI is injecting liquidity. So the overall stress that we saw in the last 2 months, where the dollar was the rupee was under pressure, and domestic liquidity, partly because of that, was tight. Both those will reverse from April onwards, and you will see a much more benign condition in non-equity financial markets, and that always has a rub-off effect on equities. Next slide. As far as earnings is concerned, from October onwards, we've seen fairly scary levels of cuts. We started off with an 11-12% earnings growth for the Nifty in October. That number has come down to 5.6, 5.5. Consensus Nifty for FY26, the next financial year, was also cut during this earnings season by about 4%. But I think we are largely done with that. As I said, we are in the middle of a cyclical slowdown that wasn't captured in numbers. Now they are. We think that the cycle turns from next year, and to that extent, an FY26 EPS growth of 13.5% is fairly moderate. Also, if you look at the composition of the Nifty, the key delta factors are not domestic consumer. They are financials, metals, and energy, which have their own own cycles to contend with. Most of them will start to show improvement from next year. So while there may be a little bit of twiddling with the estimates by consensus from here on, the large downgrade cycle is largely done. Once we get into FY26, the markets will also be a little more calm because the pressure on earnings would have dissipated by then. Next slide. As I said, EPS growth will bounce back from next year. As you can see that consistently post-COVID, we are seeing consistent delivery of earnings growth, and that has led partly to the market ratings. In Exhibit 20, we've argued that the reason why we think that there is a little downside is that the sectors which are driving the earnings growth, say consumer discretionary, financials, energy, they have, there is very little risk to their earnings from here on. So, we think that the markets will be much more calm when we get into April, because FY26 outlook will be far better than the experience in FY25. We've seen this before, right? In FY23, for example, we started off, then the Ukraine war happened, and there was a high base, and there was massive downgrades. And then, it started to stabilize, and FY24 started to look good. So, as Nirav said, we've watched this movie before. We've seen this happen. One of, India is not immune to cycles. The long-term growth story is great. Not immune to cycles. This was partly because there was too much policy tightening. As soon as that starts getting relaxed, the growth story will start to come back. Next slide. On sector, we are overweight on discretionary because fairly obviously we are looking at a consumption revival in the FY26. Beyond that, we like healthcare as a sector, great defensive industry. Telecom is a small sector, but we think ARPUs will continue to improve, and that will have a disproportionate impact on energy. We downgraded industrials to neutral quite some time ago. We are maintaining that. Uh, One, the street has to contend with the lower growth that comes, and valuations had become very frothy. Both those issues are getting sorted out, but we're still neutral. We're not saying don't hold industrials at all, because it's a great long-term story even now, but just wait for a bit for it to settle down. IT had a great run. We are very constructive on the sector, but we continue to maintain that IT is overvalued at this point, and you can't buy IT at the wrong valuations and hope to make money. Finally, our two key underweights, financials. We've been structurally underweight on the sector. We think that the sector has seen a growth downturn, which is structural after COVID, because private sector financials are unable to gain market share at the same pace that they used to. Valuations are yet to adjust to that reality. Similarly, for staples, we think that staples, there is a fundamental shift in the on the ground industry, and the large staple companies, the FMCG companies, can no more command. So access to media has been democratized, access to distribution has been democratized, and so we see either volume growth disappointing or pricing disappointing. You make money in staples only when margins improve. That is what drives re-rating, and that is how you make money in the sector. We can't see a scenario in this environment where effectively competition is much more intense for them to be able to do, both growth or and price increases, and therefore margin improvement, and therefore ROC improvement. Sector is a structural underweight from our perspective. Uh, Next slide, please. Some of our ideas, we have three large cap ideas: Lupin, Zomato, and Tata Motors. Zomato and Tata Motors are more long-term calls. We think that Zomato, this is a great time to look at it for the patient investor. They have disrupted the industry. We are not worried that the Blinkit business is losing money. We've seen that playbook. You gain market share and then you monetize. And it will be very difficult for another player to break in. Again, this is something that we've now seen multiple times in many digital categories, that the first two or three players who establish market share get entrenched, and it's very difficult to dislodge them. Tata Motors, a great balance sheet reconstruction story that was done post-COVID. The current valuations don't reflect that. Yes, there are some pressures in terms of the cyclical, but valuations capture that. Not, again, may not be a short-term call, but from a one-year perspective, looks very attractive. IndusInd is a stock. We think that this is the worst is over for the microfinance sector. Maybe one more quarter. After that, it will be a revival. Trades at very reasonable valuations at this point. Paytm is another digital story that we like a lot. Trades at a hefty EV to revenue discount. The worst of their regulatory stresses are over, and we think that their monetization paths will start to improve very rapidly from here, and growth and profitability could surprise on the upside. Finally, a couple of there, meaning I'll pick Stovecraft. Again, great, well, because they are outperforming the industry in a weak market. That is a great attribute for a potential leader. They've been a disruptor. They've come in. They've consistently gained market share. And when the industry revives in the second half, you will see this the growth come back with steroids on, and therefore the long-term growth, as we can see, 37% EPS growth is a given, I think, for a company like this. Finally, Metropolis, it's a fantastic industry, generates a lot of cash with very high return ratios and a strong moat. It's very, very difficult to establish that network. In fact, what has happened over the last 3-4 years is that hospitals which were doing this activity on a large scale have now seized it and are outsourcing it to specialist diagnostics players. So we like that company. Valuations are always expensive, but we don't mind paying valuations for companies with high return ratios and high cash generation. I'll stop here, and I think we can go to questions.
You may raise your hand and we can unmute you. You can ask your question then. Palak Naz and one more person. Can we unmute Palak Naz?
Yeah, I've unmuted her.
Yeah, hi. I wanted to know your outlook on the rupee over medium to long term.
So let me come in, then maybe Sen may want to add as well. So the fundamental drivers of the rupee eventually, obviously, first of all, you would appreciate it's a relative trade. So one thing is that you will have your own absolute value in the way how the world works, and then you are also a part of the collateral, benefits or damage that happens because of the movement in DXY. So broadly, if you look at the inflation differential, which you believe should be again a fundamental basis of the productivity differential, then I think that gap has narrowed to about 2.5 to 3% between us and let's say our large part of the trading companies on a slightly 5-year basis. Which means that broadly, if you have to try and forecast what should happen over the next couple of years, that is the kind of range that you want to look at, which is 2.5 to 3% rupee depreciation. That is one part. Now this is a long-term trend outlook based on the current fundamentals. Secondly, you should try. So, and the question is that you build capital flows on top of that, right? So, capital flows, I think, will be far more bullish in terms of what we could expect the next several years vis-a-vis to what has happened recently. And like Sain said, the third element is that DXY. I think we have broadly seen the worst of the DXY strength and therefore the impact on India. I don't think that there was a case for us to defend rupee so strongly. We have done what we have done, which means that a part of that is getting corrected now. Even when the DXY is stabilized, I think we have given away 2 or 3%. So a sort of catch-up trade that is happening. But just to summarize. If you really want to get rich as an economy, then you should always have a strong currency. Also appreciate the fact that strong currency is a fundamental basis for your lower inflation, growth, and wealth creation in dollar terms. And like I made a case in the opening statements, your local macros are very, very solid. Something that you've not seen for a long, long time, right? So, and a lot of things are falling in place. And I will just take 2 minutes to talk about current account deficit. You are at about, I guess, 1.2, 1.3% CAD. And oil has largely topped structurally. And you have $100 billion food bill on oil. So all these things are getting taken care of. I have a bullish view on rupee over the next several years. And when I talk about being bullish, essentially means that fairly lower rate of rupee depreciation than what you've seen historically. But something what you've seen, I think last 4 or 5 years, our CAGR rupee depreciation was about 2.3, 2.4%. Sen, you may want to add.
Yeah, I think largely that is well summarized. So we have to live with a little bit of rupee depreciation. That is good for us as an economy because otherwise we become uncompetitive. That carries with it certain costs on the import side, but those are costs that we need to pay. Going forward, Nida summarized it very well. The level of rupee depreciation vis-a-vis what we've seen historically will come down. I think the historic number, if you take a 20-25 year, is 3.5, it's 3.25, 3.5. That number should be more in the 2.5-ish range as we go forward because India is narrowing its both productivity and other differentials. RBI is always caught in a corner but unfortunately this rupee depreciation does not happen linearly. It happens in fits and starts. So every few years we saw in 2013, then I think somewhere around 18, 19, you see a massive, you see a massive catch up on the rupee depreciation side. Also, India is unique as a country where the where equities defines the rupee more than vice versa, because at the margin equities flows is massive compared to many other emerging countries. So in summary, uh, I think the RBI may have overdone the defense of the rupee. That is being unwound. In the short term, the rupee should settle somewhere in the 88 to 90 region. Unlikely it will go to 90, more in the 88, 89 region. And long term, it will depreciate gradually, but at a slower pace. And that will attract long term more flows. So, as Nirav said, once everybody figures out that the rupee is typically a foreign investor say, I want a 12% return from India, give up another 2-3% of that, and I get a 9% risk adjusted return, dollar return. That is my hurdle rate. Now that hurdle rate will itself come down a little bit once the new macros are determined. The other, just to finally expand a little bit on what Nirav said, uh, India's P&L was always good. It was India's balance sheet which was the problem, because we were running twin deficits, corporate balance sheets were leveraged, and banking balance sheets were weak. Today, we are in an unprecedented territory where all four markers of India's balance sheet are the best they've ever been. Current account deficit is 1%. Fiscal deficit is, as Nirav said, now settling in at 4% long term. And they, while there has been some criticism of the government on why they chose to do it, for long-term stability, it's vitally important that we keep the fiscal deficit tempered. And